Do you know why most traders end up losing money in the markets? It's because they dive in without a well-defined trading plan. That's exactly why today we're going to introduce a powerful day trading method, a smart money strategy that walks you through your analysis all the way to execution, using clear mechanical rules. Whether you're struggling with your entries or facing frequent losses, this approach will offer you a solid advantage in the markets. So before placing another trade, make sure to stick around and watch this video till the end. But first, don't forget to give this video a like and subscribe to the channel if you want more premium content like this at no cost. We'll see you right after the intro and disclaimer. This trading plan is designed as a day trading strategy, meaning traders open and close their positions within the same trading day, avoiding holding trades overnight. This approach eliminates overnight exposure and focuses on capturing short-term price changes. The benefits of day trading, when compared to swing trading and scalping, are outlined in the chart below. Day trading strikes a balance between swing trading and scalping, making it an ideal option for traders seeking frequent setups without the rapid pace of scalping on lower timeframes or the overnight exposure of swing trading. It also aligns seamlessly with smart money concepts, allowing traders to implement precise entries using liquidity, order blocks, fair value gaps, and market structure. To use this trading method efficiently, you must first understand the most recent developments in smart money concepts. These foundational ideas are at the core of this system, and your results rely heavily on applying them accurately to your charts. Let's begin with supply and demand. Supply and demand are key zones on the chart where traders have entered positions, causing the price to move sharply away from that area. Typically, we mark the start of this strong move as the supply or demand zone, and we anticipate the price to react to that zone when it returns, based on how market participants behave. However, to identify strong supply and demand zones, there are several crucial elements to take into account: inefficiency, break of structure, and push distance. Each of these factors plays a vital role in confirming the validity and strength of the zone. Inefficiency arises when price moves rapidly from an area, creating an imbalance between buy and sell orders. This can be spotted by observing fair value gaps left between sequential candles, suggesting a shortage of supply or demand at that level, turning it into a possible reversal point. Break of structure, or BOSS, occurs when price crosses a major resistance or support level, signaling a shift in sentiment and reinforcing the credibility of the supply or demand zone. Every time a structure is broken, it can point to the likelihood of the trend continuing. Push distance measures how far price travels from the zone before pulling back. A longer push usually indicates a stronger rejection, adding weight to the strength of the zone. By evaluating all these components together, you can better pinpoint high-probability supply and demand zones for your trading setups. Here's an example of a well-defined demand zone. When we apply zigzag lines to the EUR1 United States dollar-hour chart, we can observe the swing highs and lows marked like this. The most recent impulsive move meets all the conditions for a strong demand zone. It forms a fair value gap, breaks the prior market structure, and drives price upward with a notable distance relative to earlier movements. Once price pulls back into this zone, there's an increased likelihood that it will reject the area and continue moving higher. But what if the price breaks and closes below this strong demand zone? That would suggest that buyers were unable to defend the level, and sellers have gained control. It's a clear indication that the previous upward trend has ended and that a possible trend reversal is taking shape. So when price pierces through a strong level like this, it confirms a shift in market structure and reveals that momentum is now on the seller's side. This situation is known as a change of character, which signals a shift in market sentiment. However, a change of character is only valid unless it occurs under two commonly seen scenarios. At times, specific market structure setups can render these changes unreliable. Let's walk through this step by step. Here, we have a major swing low that triggered a breakout. A move below this level might appear to be a legitimate change of character. But if you examine the chart to the left, you'll see something important. This level lines up with a key liquidity zone. Here's what's going on. Many traders previously entered long trades around this level and placed their stop losses just below it. What does that mean? There's a large pool of liquidity sitting underneath that point, waiting to be triggered. Smart money is aware of this. To target those stop losses, price is often driven downward, sweeping that liquidity, before reversing sharply in the same bullish direction. The main point to remember is this: when a major swing low is positioned in a liquidity-dense area, a break below it is often just a liquidity grab, not a true sign of a market trend reversal. In this situation, we cannot treat the break as a genuine change of character. If price re-enters the range after the liquidity sweep, it presents a strong opportunity for a long entry. Why? Because the overall trend is still bullish, sell-side liquidity has been triggered, and the next objective becomes buy-side liquidity. As smart money traders, our focus is to enter after stop losses have been cleared, right when the actual move begins. But this is just one part of the strategy. Let's explore another concept that can also make a change of character invalid: the mitigation of fair value gaps. As a trader using smart money principles, spotting FVGs should be one of your first steps when analyzing a chart. These zones often attract price action, acting like magnets. In many cases, the market pulls back to fill these gaps before continuing the trend. That's why FVGs are such important levels to monitor. They tend to be most effective on intraday timeframes like the 4-hour, 1-hour, or even smaller intervals. Now here's where it gets interesting. Let's revisit the earlier scenario. If you examine the left-hand side carefully, you'll find an unmitigated fair value gap just beneath the major swing low. In these setups, price often returns to the FVG area to close the gap. This retracement doesn't mean the trend is reversing, it's the market balancing itself. The takeaway is simple: always review the left side of the chart for any open FVGs. This helps you separate a simple gap fill from a legitimate shift in market direction. By doing this, you'll steer clear of false signals and stay aligned with the broader trend. Now that we've covered this, let's move on to the next concept. Supply or demand, who's in control? Identifying market direction is the first step when analyzing a price chart. The objective is to determine the trend and assess whether buyers or sellers are dominating. Trading in line with the prevailing side enhances your chances of success. So, how does this system function? The system is based on mitigation. When price mitigates a demand zone, demand takes the upper hand over supply. On the other hand, when price mitigates a supply zone, supply gains control over demand. It might sound simple, but everything will come together shortly. Picture a market in an uptrend, forming a pattern of higher highs and higher lows. Every time price breaks structure to the upside with an inefficiency, it creates a demand zone. These zones stay unmitigated until price returns to them, offering prime opportunities to trade in the direction of the trend. However, when price moves below a valid demand zone, a change of character occurs. This indicates two critical things. First, that supply has now overtaken demand, and second, that a fresh valid supply zone has formed. From this point, price continues to drop, generating new supply zones until it finds the next unmitigated demand zone. At that level, a battle between supply and demand takes place. This often causes consolidation, leading to a ranging market between the two zones. A breakout above or below this range will indicate which side has taken control. The next principle we'll dive into is order blocks. But before we continue, if you're an experienced trader aiming to secure funding, consider joining our recommended prop firm, Funded Next. Funded Next is one of the highest-rated firms on Trustpilot, known for offering some of the lowest spreads and commissions available. They provide multiple funding options and unique services tailored to traders. If you're looking for a firm that truly backs your trading journey and financial goals, use the registration link in the description to claim a 10% discount with our special code and explore their standout offerings for yourself. Order blocks are refined supply and demand zones found on the chart where major buying or selling activity originated. These areas are significant because they often reflect where large market players or institutional traders entered positions that influenced price direction. We mark the initial candle that generated a fair value gap as the order block zone. That's because we assume the decision for the strong move started somewhere within that area. When price returns to this region, there's a higher likelihood it will respond, but that depends on whether unexecuted orders are still present. It's essential to understand that order blocks don't always work. They aren't certainties, but rather potential zones where price might behave in a predictable manner. Like any other concept in trading, they're best used alongside additional tools and confirmations to strengthen your overall strategy. Lastly, we have top-down analysis. a method focused on integrating multiple timeframes to fully grasp the overall market context. By starting with the broader view from higher timeframes and narrowing down to smaller ones for more precise insights, traders can spot the most favorable trade setups. The process begins with higher timeframes like the daily or weekly charts to establish the dominant trend, key zones, and general sentiment. These bigger picture insights give us a roadmap of where the market is likely to move. Once we've established the macro view, we move down to lower timeframes such as the 4-hour or 1-hour charts to find detailed entry and exit levels using the techniques we've covered. The key idea here is simplicity. We don't want to overcomplicate the process. So, we'll stick to the concepts discussed in this video and apply them directly to the charts. Take this example. Here's the USD JPY on the daily chart. On this higher time frame, we only need to identify the main supply and demand zones near current price action. At the top, we see the most recent high. At the bottom, the recent low. These levels are crucial because when we zoom into smaller timeframes, we'll notice they've acted as turning points for minor trends. So, when price approaches these areas again, a potential rejection may occur. There's something else to observe. The latest strong move created a bearish fair value gap. The candle responsible for this imbalance can be marked as a bearish order block, offering a possible short setup. Right now, price is testing that level. However, since the daily chart isn't where we execute trades, we must shift to the 4-hour or 1-hour charts to look for confirmation and a refined short entry. Overall, the higher timeframe trend remains bearish, and there's sufficient room for price to move before it hits the next major level. This is all we need from the higher timeframes, a clear sense of market sentiment and well-defined key zones. Now let's take a closer look at the 4-hour chart. At this stage, all we need to do is identify the market direction and highlight the key levels. On this time frame, the market is clearly in a downtrend, forming consistent lower highs and breaking lower lows. This gives us a well-defined support level to mark on the chart. Our analysis here mirrors what we saw on the daily time frame. The sentiment is bearish, and we're looking for short trades to stay aligned with the broader downtrend until the price reaches the next significant levels. However, at this point, there's no strong technical reason to take an entry at the daily order block just yet. So, let's zoom into the 1-hour chart for more clarity and a potential trade setup. On the 1-hour chart, things become more interesting. Unlike the higher time frame, the short-term direction here is bullish. The latest impulse move created an imbalance, signaling strong buying pressure. We mark the candle responsible for this imbalance as our order block zone. To refine it, we can also include the wick of the following candle within this zone. As price approaches this 1-hour order block, a clash between supply and demand is expected. If price breaks and closes below this order block, it indicates that supply has taken control. On the other hand, if demand holds, price could push higher and potentially break through the daily order block. Now let's see what actually unfolds. Price drops below the 1-hour order block, confirming that supply has taken over. This is a strong sign that the short-term bullish trend has ended, and price is likely to resume its downward path, in line with the higher timeframes. So, where do we place our entry? We wait for price to form a new bearish order block. Set a sell limit at that level and place your stop loss just above it to allow for some market noise. Take partial profits once your 1-to-2 risk to reward ratio is hit, and target the next major support levels to maximize your trade. Here's a critical reminder. Patience is one of the most valuable skills a trader can develop. Waiting for well-defined trade setups isn't optional, it's a discipline that must be mastered. Many traders, especially those starting out, fall into the habit of overtrading or rushing into positions because they feel pressured to always be active. But consistent success in trading is about quality over quantity. Let's take another example. Here we have the EUR JPY on the daily time frame. Let's identify key levels. At the top, we mark the recent swing high where price was rejected. At the bottom, we mark a potential support zone. And in between, there's a level that's acted as both support and resistance multiple times. This one is important. Currently, price has broken below this middle level, so we anticipate a drop toward the next support zone ahead. Now, let's move down to the 4-hour chart. On this time frame, the market is showing a clean downtrend, confirming the bearish direction seen on the higher time frame. That means we should be focused solely on finding sell setups. The latest move has left behind an imbalance, and we can mark the candle causing it as a possible supply zone. Include the wick as well. Since it initiated the imbalance, this gives us a broader area to monitor for trade opportunities. If price returns to this zone, we expect a potential rejection. Our next step is to drop down to the 1-hour chart for more precision. On the 1-hour chart, our goal is to refine the 4-hour order block and place our sell limits accordingly. However, we can't enter just yet. Even though the higher timeframes are bearish, the 1-hour structure is still bullish. We need to wait for that short-term uptrend to reverse before looking for short positions. Now, let's observe what happens next. Price confirms a change of character, indicating a trend reversal. It also establishes a new order block, which can serve as our entry point. With both higher and lower timeframes now aligned in a bearish direction, we can confidently execute a short trade. The 1-hour chart works as our execution timeframe, giving us more refined entries. If you want even greater precision, you can drop to the 15-minute or 5-minute charts to find extra confirmation. This can help you enter at a better price point and improve your risk-to-reward ratio. It's worth noting that this analysis did not incorporate session volume or news-related events, both of which can greatly impact price movement. Session volume helps identify the most liquid periods, improving the accuracy of your entries. Monitoring news helps avoid volatile conditions that could interfere with your setups. By applying these concepts directly to your charts, you'll not only sharpen your chart reading skills but also strengthen your understanding of price action and improve your trade entries. So traders, I hope you found real value in this video. If you did, make sure to hit that like button to show your support. And if you're new to the channel, consider subscribing so you don't miss out on future content. Catch you in the next episode.